trading at its best.
Let's go ahead and take a look at what we're going to be talking about today. Okay, first off, I don't know how many of you are new to our weekly webinars, but I am Mike Swanson, the founder of TradeWest Forex, and we've been doing these for a couple months now, these weekly webinars, and we've covered a lot of different topics. You can go to our blog and catch up and see the different things we've talked about. That's just at tradewestforex.com/blog, and you'll also be able to find the links to the replays of the past webinars we've done as well. Okay, so today is going to be all about a simple trading strategy. So far we've pretty much covered all the other topics. We've covered exits, targets, stops. We've covered Fibonacci, just a lot of different topics out there, but we really haven't gotten into any, here's how to enter the market, here's a strategy you can use for entry. So that's what we'll be doing today. And so we'll be looking at the right and wrong way to use moving averages. So the indicator we will be using, it's one indicator, but we'll be using is just the moving averages. We use two different moving averages, but it's a simple indicator, and I'm going to show you the right and wrong way to use that. And we'll be showing you a basic but a very effective trading strategy. And so it's going to seem really simple. A lot of you, I'm sure, are going to think, this isn't going to work, it's too easy, or I've tried it and it didn't work. What it really comes down to with any strategy is that you have to know there's going to be drawdown periods, and you need to stick with the system, use some of your own discretion, such as filtering out news events. For example, today with non-farm payroll, you don't want to be trying to trade a technical strategy during that event. It's just pretty much going to do the opposite many times, or just not even pay attention to any of the technical indicators. Other times there's going to be, the markets are extremely choppy and flat, and it's very obvious when you're looking at the charts, and those are the times, again, you use some of your own discretion and avoid trading during those times. So you can do some things to smooth it out, but either way you need to just give it time and always have the long term in mind. Too many traders, are thinking I've got to make a certain number of pips every day or every week, or if they don't, they're moving on to the next strategy. Well, if you have that attitude in Forex, you're really going to be in this endless cycle of moving on to the next best system. And we've had a webinar on this topic, and we've taught some different things, so you might just want to go back and review that. Today it's going to be all about how to implement this strategy. So we'll go to the charts here. Let's just get right into it. I'll be going into the charts and teaching you this, so let's just bring those up now. Okay. Now you can use any platform you want. We're just using basic moving averages today, so you don't have to download anything special. And the other thing that's nice about this is you can use any chart, any time frame, any pair that you want, and the system is this strategy you're going to learn is effective on anything. You don't have to go find a specific pair, on a daily or a 1 hour, and curve fit it to work on something. That pretty much all the systems I've developed lately have been designed with that in mind. It needs to work on any pair and time frame if possible. Now, what I found though is with robots, for example, that's where you do have to do some filtering. I have not been able to build a robot yet that can trade any pair and time frame mechanically. It's a lot more difficult. There's just things that we can see as traders that a robot, it's hard to teach it how to trade like a human. So, well, let's go ahead here. I've got some charts up. See if you guys can see those now. Okay. So let's go ahead and talk about a moving average. I'll just go over here and grab a simple moving average. Okay, let's just set it. I think the default's usually like 14 SMA. We'll just start with that. I'll throw that on the chart. And what a lot of traders I see do is they actually look for moving average crossovers, or they look for when price crosses over the moving average. And the problem with that is a moving average is naturally a lagging indicator. A moving average is what it's basically doing here. If I have it set at 14 periods, and if you see my other settings, it's based on the close, simple. If your settings look like this, all it's doing is looking at the close price. So I mean, we could turn off the candles here. It's simply looking at these close prices on each bar, each time period, and adding them up and dividing by 14. And then that's what gives you the value. That's what a moving average is. Okay, so it's not really important to understand that. You're not going to have to know how it all works when you go to trade this. But I just want you to see that because of that, because we're taking the last 14 periods and giving you the average, it's lagging, right? We're looking at historical values and we're just basically telling you what happened in the past. That's why moving averages lag. Now, let me show you what most people are doing is taking two moving averages. This is the way most traders I see that use moving averages, this is what they do. They might take, an 8 period, and let's go modify this to like a 5. That's a really common, those are really common periods that they use for this crossover technique. Okay. Now it might be kind of hard to see this. Probably should have left them thicker, but let's do that real quick. Okay. Okay, so what their idea is, they look at the charts here, and some of you probably have done this. You look here and you see this crossover and you see these big moves on the charts. Well, the problem is by the time you get that signal, by the time it's crossed over, the price is clear up here. Let me just zoom in and show you this. Let's just look at the most recent one right here, okay? Some of you see, oh wow, it crossed over and I would have made money on that trade. Well, look where the crossover actually took place. It wasn't till the close of this bar that you knew, that was truly a crossover. You would not have been able to buy until right here. That's very late. It's an extremely lagging approach to using these moving averages. Someone here says they use an 8 and a 21 exponential. I've actually built robots based on this, so I know. I've gone in and tested every possible combination you can think of. It's very easy to backtest a robot with a million different possibilities, and none of them are really worth running, using. So it doesn't matter what time, what periods, what shift, what what method you're using, simple, exponential, weighted, all of that. So now there's some of you that you might have a crossover method like this that you've made work, but it's because of your own discretion is why it would work. By itself, just trying to use this mechanically, it's not going to work very well. Okay, so now let me show you the correct way to use moving averages. Okay, let's take and what I'm going to put on here is a 200 EMA. Okay, what moving averages were designed for was to tell you, there's two things here. First off is to tell you the trend direction in the market. If price is below this 200, which is a longer term moving average, it's telling us that the price is likely to go down. If we're below that moving average, it's in a downtrend. And do you see how the market continued to move down, 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 lower, 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 until it comes back up above here? You would only want to be on the selling side of this. And if we go back in time, when it's above it, you only want to be a buyer. This is just a simple way of making sure you're on the right side of the trend. See? So look at how effective this is. Here the market turned below the 200 and it trended down 560 pips and never went above. And then finally when it did go above, it trended to the upside 417 pips. So see, this is what they were designed for. So you can see there's a big difference here, that we don't have no lagging problem here. We're not trying to time the market when it's going to perfectly reverse here. We're just trying to say, okay, if I'm right here in the market saying, should I buy? Maybe you feel like, maybe you're right here thinking, market's going up, I'm going to buy. Well, if you got this steep downtrend on the 200 EMA, you would want to be very careful taking any buy trades against that, because you can see it takes a long time for the price to get up, and then bam, the market shoots it right back down very quickly. That's what happens when you're below this 200 EMA. Prices fall faster than they rise. So that's what the moving averages are designed for. That's one thing. Let me show you the next thing. I'm going to put another moving average on here. Okay, I'll put a 34 EMA on here. Okay, now this one, with this line, I'm going to show you how you can use moving averages for support and resistance, okay? Now, during an uptrend, the market is going to have these pullbacks, these retracements in the uptrend. You see it all the time. The market heads up, comes down, heads up, comes down, just keeps bouncing up along the way. Well, you can use a moving average to find out how far back it's going to pull before it heads up. So see right here, market bounces off that moving average. It goes up, bounces off. It goes up, bounces off. Then it heads back down below, kind of tests around for a while. Then it goes up, bounces off. Comes up, bounces off, bounces off. See, it has this moving average is acting as a support level where the prices are going to pull back, find support, and bounce off. And the same thing happens to the downside. Let's go look at the downtrend. Okay, here you go. Here's what were the last couple days. Big trend taken off. Market pulls back right to that moving average, bounces off. Finds resistance again, bounces, but then it was strong and it pushed back up. Okay, that's how moving averages were designed to work. Support and resistance and trend direction. So now that you've got the basics of how they should be used, I've already given you kind of the strategy we're going to be talking about here, but the idea here is we need to pick a long-term moving average for our trend direction, and then we want to pick a shorter-term average for our support and resistance. So what the numbers I've used after thorough back testing and just trading over the years, I found that using a 200 EMA, we're going to go ahead and change this to exponential. Exponential moving average on the close, no shift, just 200 EMA is what we use for our long term, for trend direction. And then we like to use the 34 EMA for our short term for the trend direction, or for the support and resistance. Okay, that's all. That's all we need for the simple trading system. Okay. Now, let's just go ahead. It's pretty much what I've already explained, but let's go show you a trading example and give you the rules here. It's very easy. All we're going to do is say we are only going to buy when the price is above that red line, that 200 EMA. If price is above, we buy. If price is above also the 34 EMA, we're looking for a buy. So second rule, above the 34 EMA. Now, what we want to see is when the price goes above both these levels, both these lines, and it comes back to the 34 EMA, we're looking for a bounce. So we want to see it act as support here. Now this is where some of that discretion comes into play. You have to know when to pull the trigger, and I'm going to give you a few different tips here. Okay, an easy one is wait for a close back above. And if it goes too far, I cancel the trade actually. Okay, if it shows that it breaks the support, I'm not going to try to buy, right? I mean, just like any support and resistance level, if it breaks, you don't come back later and take it. So what I'd be looking for, I'll show you a clear example here, but first I'm just wanting you to see, kind of what you do in these situations where it didn't really act as support. So since the price did not immediately come back up and close above, I'm not going to do anything here. Okay, let me show you what it looks like when it does come right back up and closes above. Okay, this one here was, I mean, this one here went a little further, but this one, I don't know, that one would have been tough. I might have taken it here when it closed back up above the 34, but if I did, I might have been more conservative because it was having a hard time holding that support level. It came down pretty hard through it. Okay, well let's go back here. Maybe we can go forward. Here's one to the downside. Okay, so this is a more clear example here. You've got price below the 200 and below the 34. This is what you look for to sell. Below both of these lines, then the price needs to come back up and bounce off that 34. That's where you look to sell. Now, like I say, some of you might want to wait for that close to be sure that it is going to bounce. So you could wait for the close of this bar or the close of the second bar here. Either one of those would have got you profit on this little bounce off the moving average. Okay, made a nice 36 pip run. Okay, let me just let's go back a bit here. We'll find some more just clean cut examples, and I'll show you some of the more difficult ones as well. Okay, here's a big candle that took off, caused the trend direction to change. If we zoom out here, there was this massive uptrend, and then it finally, after this giant candle formed, it shifted to a downtrend. Okay, so if we were looking here, let's do this. Let's go one bar at a time here until we catch up to that move. Okay, so if you're right here in the markets, you're watching the price come down through both levels. So now you're just waiting for it to come back up here to the blue line. Okay, the blue line keeps moving lower. We're just going to keep watching that level. We're not going to do anything until we get the pullback. We're not trying to capture here with this strategy. We're not trying to capture this major, big initial move. Those are very difficult to spot. So we're going to take the approach of let's get the second push out of the move. Okay, so we wait for that pullback right there. You've hit the moving average. The bar has closed back below. You can sell right there. Okay, next candle, if you're more conservative, you could wait for a close, you know, a very solid close back in the trend direction, downtrend direction. But either way, you'd be in this trade short, and you can see the market took off. Made its second move down lower, broke support, made a 100 pip move, and continued even further. Okay, let's see if it comes back up again. So here you are again. If you're still in this trade, you could scale in, or if you're out and took profit, there's another place to add to your, or to get in again. Okay, this system, as you can see, is a trend following system. So it's going to work best on pairs and time frames that trend. Okay, if this is a pretty big move already, it's, you might be kind of late here. If I see something like this is a 350 pip move in a couple days, I'm going to be, this is more discretion here, but I'm going to be more careful on this entry than this one, because we've already had a giant move without a significant retracement, back up to, say, the 200. So maybe I'll take it, maybe I don't, but maybe, like I say, scale in. You can take it more conservatively, or wait for that second bar to get in. So you have, two confirmations here that it's bouncing off. Okay, now this trade kind of bounced back and forth. This is another little tip. If you get a trade like this that doesn't just pretty much immediately continue, you want to look to get out. There's no sense in waiting through choppiness for a random, I hope it's going to go my way, hope it doesn't bounce up. Most of these trades that are successful are going to be like this one. They're going to quickly bounce. That's what you're looking for. So if I see this kind of thing happening, I'm getting out of this thing. Break even, I'm getting out with a little bit of profit, and I'm moving on. Okay. Sometimes it's going to continue. Other times it's going to bounce the other direction. I'm going to show you many, many cases. Here's another one. It bounced around for a while. I'm going to take profit on that one. Okay. If I'm short here, I'm going to be more conservative and start to get out as I see it bouncing around. Because at some point that trend is going to turn the other direction, and that's what happened here. It went up 62 pips. Okay, this one we missed out on some profits, but I think that's better than like this one. If we would have tried to wait it out, we might have lost 60 pips. Okay, so this stuff, as with any system, it's going to take practice, and I think a really good way of doing it is what we're doing right now. Just sit here and watch each bar. develop with, don't look at you have that benefit of hindsight. Don't go, scroll to some chart in the middle and look at it and say, here's what I would have done. That's not going to teach you anything. Instead, you look at it one bar at a time and watch how the markets react at these levels. Kind of draw the line, you can draw some arrows on there and see how you would have taken the trade, where you would have exited, and basically simulate the system for yourself. Okay, so one other little tip here with this system is the further away it gets from the moving averages before the signal, the more effective the trade signal is going to be. So you see this one, huge deviation, distance away from those moving averages. We're sitting here at 130 pips away. So when the price starts to pull back, I know that this is a very strong signal that we're going to get, a good amount of momentum back in the to the downside. Okay. Whereas, let's say we go look at some of these minor little retracements here. Okay. See here, we weren't very far from the moving average. Very short distance away results in a very small move. So that'll help you guys figure out where to put targets, and based on how far away it was when it came down. The further away, the greater chance for a bigger move. Okay, now let's see here. I'm gonna go over some more examples. Let's just scroll back here. Okay, here we are. Let's just show you, just like you would do this in real time. Okay, once the price is below the moving averages, you're waiting for it to come up to that 34 EMA. And right there, it came really close, bounced back, comes back up. Well, now you're above it. We would want to see it close back down below as an added, an added filter to prevent these false continuations. And that one did not, so no trade. Now we're above the moving averages, so we're looking for it to hit that 34 and go back up. Okay, here it came really close. You might have been able to buy on that close. The second one, I think that's too late to buy way up here. So if you didn't get in here, it doesn't always have to come right to the moving average. But here, it was really super close. You could have bought on that close. Market went up. Okay, let's look for the next one. Right here, it touched it, closed. So see, if you're using the approach of I just want the first bar to do it, this would have been a loss. Losses are going to happen. Let me just tell you here, part of the money management, to kind of give you the whole strategy here, or kind of giving you a suggestion for targets. I'll put this all together for you guys. But for the stop side of things, you don't need big stops on these trades. If these trades don't pretty much immediately take off, just get out of them and take a loss. Okay, you can be very conservative with the stop here, very tight stops. I'm talking about, don't go use your past swing lows. That's going to be way too far away sometimes. You really don't need, you might be able to look at the ATR indicator if you have a hard time kind of visually seeing where a stop should go. Let me just do that for you guys. Take, say, let's go with like, these are really shorter term moves, so I'd say maybe like a 10 period. Okay, what you can do is look at, when you take that trade, look at what the ATR value is. And maybe you can go 1 or 2 ATRs for your stop. So see, it's 24 pips. So I'm going to use either a 24 to 48 pip stop. Maybe I'll go in the middle and go with maybe a 35 pip stop. Okay, so that's going to put my stop. It is going to be somewhere about right there. Not clear out here past this support. Really small stop. So that way, 30 or 35 pip stop, I can get huge, risk to reward ratio out of this. I can get a 3, 4, 5 to 1, or 1 to 5, I guess, risk to reward. And that's what you need with these trades, because there's going to be those times that the market's choppy and you can't filter it out very well and you're losing. Okay, if you're in here with a 30 or so pip stop and you're making 90, you are going to only have to win 20 or 30% of the time. And that's a much better way to trade than having to be right 80, 90% of the time because you have a bad risk to reward ratio. Okay, but we're not going to cover a lot of money management today. We do have a blog post and webinar we've already done on that. You guys can go back and review. Okay, but I just want you to know that if you take a trade like this, let's do the same thing on this one. Okay, you're over here. You take a buy trade. You follow it just like you did here. You took it on the close above, and so we look down here. It's 14, and so we said, take about 1.5 of that or 2. You're looking at a 20 to 30 pip stop. So let's just say 25. Okay, so that puts you at 90 for the stop. Okay, we don't need a lot of room. Maybe we go for 2 to 1 on our target. So we'd be looking for 50 pips somewhere up in here. But anyway, we get into that trade with a small stop. And sure, we take it out for a loss. No big deal. You move on. If you follow good money management, you don't have to win more than half. You don't even have to win half the time. I think that's the important part with this strategy and many others is you need to know what your risk to reward ratio is, and try to get that as high as possible, better than 1 to 1. So then, who cares if you're losing half the time? You're still going to be able to make some money. Okay, let's just keep watching how this goes here. Look at some more examples. Okay, now let me just point out something. This is where I just want to make sure you guys understand this. If you have it above the 200 and now above the 34, you can't just buy right there. You need to see this separation. Okay, you need to see it actually. The lows need to come off and not be touching the moving average at the very minimum. Okay, so if you're looking for some specific rule, that's what it would be. It needs to have the low of a bar that's finished, closed and done, needs to be not touching the moving average, that 34. So here, once this is the first time you could now be looking for an entry. Okay. So now if it comes down and hits this line, you could buy. Okay, and then like I said, though, the further away it gets before coming back, the stronger the signal is going to be. So in this case, it didn't get very far. We'd wait for a close back up above, and so you have no trade. Okay, let's see. Now this one got a pretty good distance. Okay, right here you've got that either this first bar or the second bar you'd be in on this trade. Okay, now we could do this basic little stop loss approach of let's just look at the ATR. 20 pips, so we'll go about 30. Go 20 to 40, so we'll just say about 30. Okay, so we'd be looking at somewhere right in there, about right there's 30 pips. Okay, and so if you got in here, you would have been able to hold it through that little whipsaw, and starts to head up. Now you have a 30 pip stop, and it got up almost 30 pips. So you could start to scale out at around 1 to 1. If the trade is kind of slowly progressing like this and starting to pull back, here you could buy again and add to your position, or if you're worried of the trend turning back down, you could take your trade out with a small profit. Here it actually bounced, so you could take another trade on that close or the next close. Look at the stop again. You'd be looking at about 20 pips on that one. Somewhere in there. Okay, heads up to 40 pips, 2 to 1. So you don't have to get a big move here, guys. Take profits on these. Take that 1 to 1 if that's, while you're learning this system, 1 to 1 is going to be great. You're only going to have to win slightly more than half the time to make money, and overall. So take these profits. Take the 20 pips. Take the 40. Take that 2 to 1 and move on. If you miss it, here it comes down again. You could buy. This trade over here was actually up like 3 to 1. But anyways, you buy this one, put your stop in, 20 pips or so. That one would have been somewhere around here as well. Heads back up. You guys get the idea. I'll keep showing you guys examples. I'm just wanting to make sure you see that you kind of get an idea how the system works in a real-time, almost real-time filling by watching this kind of bar by bar like we're doing here. Okay. Now soon I'm going to be putting together actually a course on how to trade the markets kind of similar to the way we're doing right now. Right now I've given you a really basic trading system, but I'm going to teach a full-on trading plan based on what we're doing here. You know, watching the trades bar by bar and actually placing stops and targets through your risk to reward ratio, not through looking at some support and resistance level or some other indicator, but by strictly just looking at, you know, a little bit of the volatility of the move, or the, you know, through the ATR. But once you have the stop, or once you have a target, use those numbers to determine where to put these stops and targets. You know, all based on risk to reward ratio. So I'll have more information for you guys on that. But I think you guys are getting a good feel for how this system works. If you guys have some questions, you can feed them through here at any time. I'll go to some other pairs and time frames as well. I do see some questions. Are there any pairs you would say they're known as classic trending pairs? Yeah, let me go ahead and show you some of those. You know, with my system Momentix, it's a system that we like to find trends and breakouts on, so we've already done some of this research. And we've found that, you know, there's pairs like the pound yen. Okay, the pound yen is one that it really likes to break out in trend. Usually, I mean, it's a little choppy as you can see here on the hourly, but if you go up to like the daily, very big, you know, on trending on this pair. So some are going to be better trending at lower time frames. Others are better trenders on higher time frames. Okay, let me show you. Another one is the Euro CAD. Okay, you can see this one, very smooth trending, which works very well with this strategy I've taught here. Go down to the 4-hour, even on the 4-hour, really strong moves. Not a lot of whipsaw. I mean, it's not perfect, but it's one of the better ones. And then you've got Pound Australia is another one we like to watch. Pound Australia dollar. Let's see where that one's here. Right there. Okay, this one's really solid trending. I mean, I'm on the 4-hour chart, and for the last couple months, there would have been some great trading here, right? I mean, I'll just use the F12 key on this one and show you. Okay, there's a close one there to buy. Right there's a buy. Right there's a buy. Heading up. I mean, think about this one here. You've got a 40 to 60 pip stop, and you're looking at 237 pip move. Okay, here's another buy trade. Takes off again. 200 pip move. Here's another buy trade. Takes off 100, 200 pips. Another buy trade, 260 pips. Okay, this one failed. I mean, it didn't close back above, so you probably could have filtered that one. It didn't close above. It needs to touch it and close above. Kind of help you filter these false trades like this. Okay, then it did come back up though on this one, came down. Here it did close above, so you might have got in there or on the late bar there. Okay, another one closed up above, really nice there, 130 pip move. Closed back up above. That one gave 230. This one was really good here. 550 pips. Even further, it just kept going on that one. You're looking at 930 pip move. This one would have failed, but it didn't close above, so you would have been able to avoid it. Okay, here you go. There's a buy. It's crazy to see. This is probably 90% winners right here. I mean, that doesn't happen in the long run, but you will get those times where you're very accurate, and you'll also have the times where it's not working so well. But like, here's a really good pair, as you can see, though. It's been trending for months and months. A lot of good trading. Okay, time frames that we recommend. I would say this system, it can work on any pair and time frame, but most new traders, I always suggest that they start with any system on 4-hour or daily charts. And the reason why is because if you can't be successful on a daily chart, you're going to have no chance of being successful on a 5 or 15 minute chart. And the reason why is because when you go down to the 5 and 15 minute, the spread starts to eat into your profits. has much bigger effect. You have a lot more impact from news short term. You might get sitting there on a trade for an hour and the news just wipes you out and just takes off and ruins the technical setup. You'll have a lot more stress, I think, and emotions involved as a day trader on a 15-minute chart with any system. So I like to say start off on the dailies. I mean, you can go to any pair you want, and there'll be plenty of setups. And just get familiar with the strategy there first. And like, you know, these moving averages you will find that they are more effective as support and resistance, that 34, on a higher time frame, because you know there's a lot more. You know, basically, the market support and resistance is made up of trading orders. So there's a lot more. You know, there's a lot more stronger orders at these levels on a higher time frame than say a 5 or 15 minute. There's not as many people sitting here with buy limit orders at this price versus a daily chart. Okay, but like I say, you can do it. You can be successful in the 15-minute. It's just probably for a more advanced trader that has got their emotions under control and is very quick at making decisions and knows how to avoid the flat times of the day and the whipsaws in the news and all that stuff. So on the daily chart, we pretty much look at the system the same way. We're not doing really anything different. Same rules. Okay. Well, let's look at another one. Another good one is the euro-yen. Okay. So you can see here a lot of big trending moves. There's going to be those times where if you miss the initial move, it might not quite pull back, and it might just keep going, and that's fine. Just don't get nervous and feel like you got to go jump in the trade. Just go look at another pair. Just go grab another pair. You don't have to get them all. Okay, let's see. Let's go back over here and look at some more examples. Okay, so again, if the price is below the 200 and the 34, what are you doing? You're looking to sell when it comes back to that 34, that blue line. Okay, so it didn't quite make it there. Here we did. Came up really hard, bounced back. So you would either have been able to sell on that close or the second bar close, depending on which way you're doing this. It's all up to what you're comfortable with. Sometimes you're going to be late one way or the other. Okay, so market bounced back. If you're looking at the money management, just a basic money management system we've been teaching here is look at the ATR, say a 10 period, and times the value by 1.5 to 2. Here you've got it sitting at 178 pips. Okay, so maybe go about 250 pip stop. Okay, you might want to review our webinar I think we talked about it in brokerages, the brokerage webinar, but basically don't be worried about big stop losses. The pips don't really mean anything. All you have to do is make sure you're calculating your lot size properly, and that's fine. You can still be conservative and not risk a lot of money with even 1,000 pips. You just have to make sure that your lot size is calculated properly and you're not over leveraging on the trade. Okay, so if we were to sell here on this trade, on the close, we'd look down here. We said about 250 pips, so that puts your stop about right up in here. Okay, somewhere right up in there. Okay, and the market came up only a little bit, bounced back, and then like we say, look for like 1-to-1, 1-to-1, 2-to-1, take your profits. So if you're looking for 250, it got up to 300. So you would have easily got 250 on that trade. If you're going for 2-to-1 on this one, it didn't quite make it there, but if it doesn't make it and starts to come back, take the 1-to-1. There's a lot of different things you can do for the exit. Okay, it comes back right there. We need to close back below, and there you go. You can sell again. You look down here, your stop's only going to have to be about 150 now on this one. Since the ATR is at 100, I'm going to take 1.5 about on that, so 150. So on this trade, you'd be at 112.62 for your stop, somewhere right in there. Okay, easily takes off, very easily makes 150. That one you did get 2 to 1. You know, hold out for that 2 to 1. If it doesn't get it, it comes back to 1 to 1, then get out there. Take your 1 to 1, take your 2 to 1. You know, scaling out's a very good approach with this system. You see, sometimes you're going to be able to scale out at 1 to 1, scale out at 2 to 1, scale out at 3 to 1, and ride that thing out 4, 5, 6 to 1. That's going to help improve your strategy so that you don't have to win all the time. That's what this is all about, making it so you don't have to be right all the time. You don't need a system that wins 80% of the time. If you got a good risk to reward, there's times you only have to win 20% of the time if you're doing this right and catching the moves like you should. Okay, any other questions? Probably going to get ready to wrap this one up. I've given you lots of examples. Okay, here's another one, comes up, hits. You sell right there on the close. You look down here, it says 138. So we'll take that about by 1.5, puts us at about 2, we'll just say 200 pips. So that puts you entry about 106.42, somewhere right in there. Okay, that one gets stopped out, and that's fine. How many of these trades have we done that were successful? I would say we're much higher than 50%. So it's okay to take some losses. There's going to be times you do take a couple losses in a row when the market's choppy, and that's fine too. I mean, sometimes you're going to be able to avoid it, sometimes you're not. And when you're not, you've got to stick with it, keep going, because you know these trends are ahead. Okay, so here you do nothing. When the market just sits here and bounces around, you do nothing. You need to wait for this trend to get going and then wait for that pullback to the moving average. Okay, so it would need to get a high below this moving average, right? And it never did that. Okay, right here it finally did. Now we've got the high of a bar that's not touching the moving average. It's below the moving average, the 34. So now we could take that sell trade right there. Okay, we can look down here, take about a 200 pip stop, put you at 108.02, somewhere right in there, and that one turned out profitable. Okay, 200 pip, you got 270. You easily got 1 to 1. And maybe, let's see if it got to the almost 2 to 1. Okay, right here again, you're in the trade, got a signal to sell right there. You look down at your ATR, you're at 94, so you go about 150. Puts you at 106.22. There's your stop. And you easily got your 150 pips. 300 is your 2 to 1 on that one. And looks like you probably could have got 3 to 1, 4 to 1. See, this is when where you hold out. You do scaling out. Scale out and move it to break even, or make some, move it to 50 pips, whatever. Just make sure you're trying to capture these moves. It'll make it so you don't have to win all the time. So that one right there, what did that go? 150, and you made 750. So 5 to 1, 1 to 5. Okay, that's going to make it so over here when you take this trade, if you sell on this trade and you lose your 150 on it, that doesn't matter because you've taken all these other trades and you've been making money. You've been making 2 to 1, 1 to 1. So over here when you lose, it's not a big deal. And I'm not even sure. Let's see if that one did lose. 150, yep, that one would have lost. Okay, any other questions? What is the red EMA? The red EMA is a 200 EMA. That's for the trend direction. We want to first see that the market is below that level if we're going to sell, above if we're going to buy. Okay, if I zoom out, let me show you here where you get that little conflict. Okay, here's where you see It's above the moving average, the 200, but it's below the 34. So you expect the market to chop around like it did until it gets below both of them. Then you've got a trend, hits the moving average, you sell. Okay, hits it again, you sell. Hits it again, you sell. And you make the profits on the rest of that downtrend. Edgar says, as always, Mike, you kept it super simple. The KISS acronym there. But highly effective. Thank you for sharing. Yep, I think I just hope you guys will put this to use, because this is a very simple method. I know that some of you might have tried this before and gave up on it, but I know if you give it enough time and you follow the rules and you don't let your emotions get involved, you keep your risk to reward ratio up, that you're going to do fine. This system can definitely, as I've already shown you, can easily win more than 50% of the time. And that's all you need with 1-to-1 is a little bit better than 50%, and you're going to be able to make money. The win rate for the strategy, I don't have any exact numbers on that because it's not it looks like a mechanical system, but there's still some discretion involved here, right? As far as like where we put our stops, where we're scaling in, or if we're scaling out. So I mean, some of you are going to be able to go out and trade this and be 70% accurate. Others are going to be 30% accurate. But at the same time, both of those types, both of you could be making money. It's just up to the risk to reward. The win rate by itself doesn't really mean anything. Okay, I'm just saying, if you only win 50%, make sure your risk to reward is 1-to-1 or better. You actually need it to be a little bit better if you're right at 50%. Okay, the recording for this, let me go ahead and show you guys where we put those. You can actually just go to our blog. Just go to TradeWestForex.com/blog. That's going to be the easiest way to find all of our past recordings and a little summary of the topic. So here it is, TradeWestForex.com/blog. Just scroll down and you'll see, here's the link from today's post to sign up for the webinar. Okay, so in one of these posts we'll say replay. Just scroll down here. Okay, here's sign up. These ones you can get to the replay too, but I'll just show you. One of these will say how to get to the replay. I'll just type in replay here. Okay, live webinar, watch the replay here. Anyway, if you just go to TradeWestForex.com/webinar/weekly, it'll redirect to this page, and this is where you watch the replays. Okay, and that's where you also find the post. So you might be easier. Just go to that link. I'll post it in the webinar chat here for you guys. So of course it won't be up for a few hours as we get it converted, but you can check back there. We do send an email out announcing when it's all up and ready to go. But that's the link. It's just TradeWestForex.com/webinar/weekly. That's where you can go watch those replays. Okay. Now the ATR, all I was doing was taking just took a 10-period ATR, looked at the value down here. Now I'm on a daily chart on this 3-digit pair, so it might be a little confusing, but that's basically 111 pips. So I was taking that and just times it by 1.5. And you guys can do this. You can determine what works best. Maybe you don't have to go that far. Maybe 1 is fine, or maybe you need 2. You'll have to kind of tweak and play with that for different pairs. And the way you can learn that, go do what I've been doing. Go pick a pair that you want to trade, drag it over a ways, and then just use the F12 key to kind of walk yourself through it and get a feel for what it needs. If it needs more room, multiply it by 2. If you find that it doesn't need a lot of room, the tighter you can get the stop, the better. And I'm just multiplying it. In most of these examples, I'm just multiplying it by 1.5. And then I'm just putting those number of pips for my stop. Really simple. Okay. So I think we've answered some good questions here. A lot of you seem to have enjoyed the method, the training. Really simple, easy, and effective strategy. So I hope you guys have success with this. And if you go out and trade this strategy, next week you have some success with it, post some comments on the blog. Okay? If you go over here on the blog page, okay, you can go to the simple strategy right here and click on comments, and you can leave a comment there. Oops. Yeah, right there. So you can leave a comment about it. If you like the way the system worked, or if you have had some nice trades with it, leave some comments so others can see that it's working, Okay. Well, thanks again, everybody, for coming. We'll let you know when this replay's up, and hope everybody has a great weekend.